name. For those I haven't said, thank you. Good afternoon, everybody. Johan Burger is my name. For those I haven't greeted as yet, we were just waiting until 12:05 to start this session. I'm one of the directors of SAFMA, and this morning we've organized, or today I should say, we've organized a webinar on public-private partnerships, fact or fantasy, and we got 4 panelists that are raring to go. I'm going to be introducing them to you shortly and giving you a short bio. We're going to just run through a few housekeeping rules. Please post any questions you have on Q&A. We're going to be asking the panelists to be speaking for approximately 10 to 15 minutes each, which will last around half an hour at the end of the session for any questions that can be posed and answers from the panelists. Bear in mind that some of the information could be confidential, could be seen to be confidential, and perhaps they can't answer you directly, and that is answering your questions directly, but I'm sure we'll get to that. So without any further ado, I just wanted to introduce you to the 4 panelists today. We're going to be asking Patrick Dominy to start off the sessions, and he's going to be talking on sector participation. And secondly, we'll then be moving on to Bo Kleinhans, and he's going to be talking to us on contractual matters. Thirdly, we're going to be moving on to Cliff Hocking, who's going to be talking on operational issues. And then we'll wrap up the session with Rachel Makuza. Perhaps Women's Month, she should have been first, but we decided to move it down, talking on structure and financing. So just a bit of brief background on each of the participants, a brief bio. Patrick Dominy owns his own advisory business, Dominy Associates, operating within the built environment, specializing in corporate property, portfolios, healthcare, and PPP transactions, advisory opportunities. Patrick was previously a global partner at EC Harris. After 2012, went on to manage their various businesses and associates, but has continued to be actively involved in facilities management and PPP advisory services. And he's given me a list of Dominy Associates currently involved with the following facilities management related projects, which I won't go into. It's quite a long, impressive list, and I'm sure you'll talk to it. It varies from hospitals to student accommodation to quite a few others. So that is Patrick's bio. I'd then like to move on to Boa's bio. Bo has also given me an impressive list here. He holds a diploma in civil engineering, MBA from University of Pretoria, worked in the civil engineering field for 13 years, specializing in wet services and design for buildings. Since 2002, has been working in various positions in the facilities management environment and is currently head of public-private partnerships at Tasebo Solutions Group. He has extensive public-private partnership experience and was involved in structure negotiating FM contracts for 4 accommodation PPPs. And there's a whole other string of his credentials he's given me, and very impressive. And we all know he also wrote and author of the book's SA Facilities Management Handbook. So that's a welcome to Boa. Next, I'd like to welcome and give a brief bio on Cliff Hocking, who founded Wilconox Facilities Management Services, a specialist consultancy in 2011 after many years in the facilities management sector, managing in-house FM operations, outsourced FM contracts, contract mobilization and implementation, business development and marketing, as well as PPPs in terms of bid management, private party management, operations and maintenance management, and consultancy services. I know Cliff has kept his bio very short, and thanks for that. It makes it easier for me. Rachel Makuza, welcome to Rachel, is the Managing Director of Motseng Concessions, which oversees the group's infrastructure investments and public-private partnerships. She joined Motseng Concessions as Divisional Chief Financial Officer after spending 7 years at EY, Ernst Young, and 7 years working in public practice. She took up a current role in 2018. She is a CASA. So we've got 4 very strong panelists, and we're really looking forward to what they're going to be telling us about public-private partnerships this afternoon. And may I ask Patrick Dominy to talk to us, please, on sector participation. Patrick, thank you very much. Over to you.
Thanks, Johan. Just going to share my screen quickly. I'm sure everyone can see that.
Yes, we can, Patrick.
Yes, thank you.
Thank
Patrick.
you. Right. Good afternoon to everyone. I was given the first slot to provide an overview of how the FM industry can participate in the PPP sector. As Johan was saying, I have got quite a varied background in projects, anything from construction to advisory to FM. So probably relatively well placed to give this overview. So without any further ado, I will proceed. Now, you may or may not all be familiar with the fact that GTAC, or through National Treasury, has quite a well-regulated process that is followed with all PPP type projects. It is quite detailed, it is regulated, which are all the good things, but there are a number of hurdles and pitfalls that we'll look at the next few slides. But what I've tried to do is sort of break it down into more of a logical process from a PPP perspective that we can hopefully follow and understand. Now, we can diagrammatically present all the processes that we have to follow from where a department or an institution identifies a need, sort of conceptualizes it into a project, and then will appoint a transaction advisor. This is really the first point of call where we can start tracking projects and how best to participate in them. GTAC has a website with projects that are recorded and logged, probably not always well updated or regularly updated, but that is sort of the first call that we start picking up these projects. Transaction advisors typically play in the space of determining the feasibility of this work. Goes through a Treasury approval stage 1, then bid documents prepared, and it's really at this point that the FM industry in the collective starts identifying it as a real project. Now, as most of you are very familiar with this, there is an RFQ, RFP, and evaluation process. You then get preferred bidder, and you move towards commercial close and financial close. Prior to the project, if it has a development period, it goes into a design and construction period, and then followed by what we're all after is a 15, 20, 25-year service period. What we are also starting to pick up now is sort of the last stage of a project life cycle, where the institution or the department is determining what the relevant exit strategy should be. Should they take the asset back in-house? Should they extend the current contract, or should it go back into the feasibility stage? And that's where we're finding now as a number of projects are getting to the end of the service period and are going back into some sort of exit strategy, and feasibility studies looked at again. So that is really the full life cycle that we collectively should all be playing in. And what I want to do next is not provide you with a project pipeline, because I don't think there's anyone in this industry that can provide a project pipeline with any degree of accuracy. So what I've done is taken some projects and put them in their sort of relevant boxes. And I'm going to look at some of them. I definitely am not going to look at certain projects which not only are there members on the panel who we are competing with, but I'm sure there are a number of other people that are participating in this webinar that we may have conflicts with. So those I'm going to talk briefly about, but not in any level of detail. So from an inception perspective,
Patrick?
Yeah.
Sorry, lost you there for a moment. Thank you.
Yeah, so it's from an inception perspective, we do know of a couple of projects that that are being conceptualized, but it's that pipeline of project X, Y, and Z that I don't think anyone really has a handle on what this pipeline looks like. There are a number of projects that are sitting in the feasibility stage. One project that I'm currently involved with is the student housing accommodation through the DBSA. There are a number of larger projects broken down into clusters. We're just working on the one cluster. That's a nice, straightforward project. Whether it goes to PPP or not, who knows? That will be based on the feasibility study, but there's definitely work that is in this pipeline that's coming through. There's some projects in Africa that we're picking up. Hospitals obviously are a key focus. As mentioned, there are a couple of projects in the procurement stage. And obviously a lot of existing projects in the service period, such as STATS and DTR and DERCO, all the sort of older accommodation projects that are meandering through their 20-odd year service periods. And then recently, as I mentioned, there are a couple that are going through an exit strategy. And the first one is Albert Lutuli, which is one that I don't want to go into a lot of detail on, but that's a project that has been managed over the last 20-odd years, and it's coming to the end of its service period. So it's a facility is old, has been maintained through a public-private partnership, but is coming back onto the market, and that introduces a whole bunch of new risks and dynamics that you're taking over an existing facility and not a brand new one. QMMH is Queen Mamahatu Hospital in Lesotho. That there, the Ministry of Health has recently taken it back in-house. Free State Department of Health, Universitas and Pelonomi, that's an existing PPP contract that is also coming back into the market. The transaction advisory tenders have been out, and that's, as I mentioned, two existing hospitals that will come back onto the market in time. Gautrain, the existing Gautrain, there's a TA appointment out for an exit strategy of the existing line. Obviously, there's also new lines, new extensions that they're looking at. And then Port Alfred and Settlers Hospital also have been taken back in-house by the relevant department. So if you had to look at it as a pipeline, those are some typical projects that are, as I said, meandering through the process. It's most certainly not complete because projects do get added on and fall off quite regularly. So if we come back to the theme of today, is it fact or fancy? Or fiction maybe is probably more appropriate. What I know my colleague Bo is going to talk more on this, but the draft NRP for 2050 claims there are 273 projects coming our way through this initiative. So where do you think they will lie? What I've tried to do is, based on what I know and my views, not any views of SAFMA or anyone else, but to try and identify against probability and sort of scale of investment where they lie. If you overlay sort of the need, you'll get a very different picture because everyone will have their own interpretation of needs. But so I've limited it to probability of it happening and investments. And we kind of get the old faithful office accommodation, high probability, relatively low investment compared to other type sectors. So I see city regeneration being probably a greater need than one-off buildings. But definitely the accommodation, everyone loves a new office building and hopefully the productivities that go with it. What I've seen, for argument's sake, in the Salvacorp area, there are a number of schemes that are planned in that area. I was involved with stats, and it was quite fortuitous because there was vacant land at the time, and that's where stats has gone in. We had some severe infrastructure challenges and also community-based challenges. So the next project coming into Salvacorp is going to have to solve the community and the heritage issues in that area. And I think that's probably one of the leading reasons why there has been some lag in that particular node. We obviously all know about Kopanong and the benefits of that's going to have on the inner city of Johannesburg. So we wait patiently for the news of that. But office accommodation and built environment will definitely be an ongoing opportunity. Healthcare, obviously got some background on healthcare. I think the probability of occurrence is quite high. It's how the public will go about it. They've historically, we've had some co-location, smaller projects, but the current flavor of the month of these big central hospitals like Albert Luthuli, like Tygerberg, like King Edward in Durban, and various other, and up here as well in Gauteng. But to try and resolve a central hospital, you're just inundated with complexities because you're dealing with national and provincial departments of health, you're dealing with national and provincial departments of education because they are teaching facilities. You're obviously dealing with the medical schools. So there are a number of stakeholders that have to be managed to try and solve a central hospital. So ideally, we should be looking at some easier type facilities within the healthcare space to solve. But I think from a probability and a need perspective, it's right up there. Rail infrastructure. So we hear a lot about Gautrain. As I mentioned earlier on, there's sort of round 2 of the existing projects is in the pipeline. There's a lot of talk around the extension to the existing line, what the route is. It's in the market at the moment where stakeholders and interested parties can comment. So that's definitely on the pipeline. But there's little mention of cargo or non-commuter type rail. I think these are also attract some, well, come to the party with some big issues around solving ports, be it inland ports or actual seaports, solving those congestion issues. But you would expect that has a great need in the future. Sorry, I'm going fast, but I've got a time limit.
I think that's fine. No, another 2 minutes. You're doing very well. Please keep going.
Okay, cool. Education. Yeah, we are seeing student accommodation, but the traditional education sector, I think, is a huge need. But probability of coming to market in the short term around traditional schooling type projects is probably low, although it is has a low investment requirement, but I'm not seeing any such movement in that sector for now. Business improvement projects. This is really sort of non-built assets and non-core to the government or the institution. So they're going to be looking for business improvement and system-driven solutions. You know, so it might not be core to the FM industry, but providing a data center might be not core to a particular department, but it's something that some of our colleagues in the sector are definitely getting involved in. So keep an eye out for these business improvement type projects. We're seeing a lot of it overseas, and I suspect it'll come here quite quickly. Infrastructure, okay, this is obviously the big one. You've got all the big ports and power generation type projects that have a huge capital investment and will have a long lag in terms of delivering. But then you've got the other IPP type projects, which we've seen a lot of, and will carry on going forward. And so if we just bring that all together, short-term projects, I think our collective opportunities are trying to focus on whatever low-hanging kind of fruit are coming through the pipeline, partnering with key people, whether it's a construction company or whether it's a actual service provider, for argument's sake, solar powered service providers. These are the obvious opportunities in the short term. Keep your eye on accommodation and health.
Patrick, sorry, I'm going to be asking you to wrap up shortly. Thank you.
Cool.
Sorry to cut you short. It's really
no worries.
Keep going.
We'll skip this one. So I think really to conclude, there is a pipeline. There's a bigger wish list than capacity in the pipeline at the moment. We know that there will be project lag. That's a fact. Stakeholder management, I think, is a big hurdle that we all have to get over. This is the third P in public-private partnerships. It's the partnership bit. We have a lot of challenges in trying to make these marriages work. Construction capacity is currently low, but I do believe that in a PPP, the FM companies are needing to take a much greater role in developing these PPPs and not relying on the construction companies to do the majority of this work. So just to conclude, my real challenge is those who have read this book, Who Moved My Cheese, it's something, other than it being a quick read and probably worthwhile, it's really, our market is moving and we need to keep up within the FM space. Somebody's moved our cheese and we've got to go and look for where this is. And I honestly believe PPPs will be, maybe a little bit fanciful right now, but in the next few years, we're going to have 273 projects that we have to start delivering FM services on. So that's my bit, Johan. Thank you very much.
Thank you very much, Patrick. I think you've given us a very good overview, very good introduction to this session. Sorry, I had to cut you short there on sector participation. You're raising the bar there in terms of fact or fiction. We had it down as fantasy. You've saying there is, perhaps there are some PPP projects in the pipeline. 273 sounds like a lovely big number, and I'm sure it's going to raise a lot of positive comments. So thank you very much, Patrick. Sorry, just going to move on to our next speaker. And before I do, that's Bo Kleinert. So I just want to mention the session is being recorded. It will be made available to all SAFMA members. So Bo is going to be talking to us about contractual matters. Bo, 10, 15 minutes. So over to you. Thank you very much.
Thank you, Jan. I don't know if you can see my screen.
Yes, we can.
Okay, good. At least that's working. Hello, everybody. Thanks for joining this. I've been asked by Johan to talk about contractual matters. And I thought maybe just to be a bit more holistic, to start off, obviously with the regulations. Patrick already mentioned that all PPPs are regulated, and it's called Regulation 16 of the PFMA. And for municipalities, it's the MFMA, and Tshwane House, for instance, was done under the MFMA. But most of the PPPs are done under Regulation 16, which is controlled by the PPP unit within National Treasury. Patrick also mentioned that, that plays an important role there. And then they prescribe, or they've got a guideline, a PPP manual, which is quite handy if you're new to PPPs and don't understand how it all fits together. It's quite helpful to get the PPP manual and for some bedtime reading. The main thing is that National Treasury controls and regulates and support PPPs. So if you are approached maybe by a small municipality out in the sticks to build office accommodation or some infrastructure for them. The first question is, how far are you in the approval process with National Treasury? And Patrick had that very nice slide of that approval processes there. So that's the first tick, to make sure that the project is registered with National Treasury, and only then is it a PPP. Otherwise, it's just some other form of procurement. So just, and you'll get people talking about this is a PPP, and for instance, but you get a lot of other projects that's not real PPPs, and they haven't got National Treasury support. Just quickly, a test for a PPP: can the institution afford the deal? Is it a value for money solution? Patrick also just discussed or touched on that. And is substantial technical, operational, and financial risk transferred to the private party? That's almost the three simplistic tests for a PPP. The third one, that substantial risk transfer, just by the nature of the contractual arrangements, and we'll go through that contractual arrangements now, that is actually covered. So you pass the risk down to those, to the private party. The bigger questions is, can the institution afford the deal, and is it value for money solution? The value for money is quite a stringent test, where a department might say that they can just straightforward lease a property for a period of a 10-year lease. It's going to be a lot cheaper than going through a PPP process. But the PPP has got other advantages, and that transfer of risk and the financing thereof as well. So, and then to add to what Patrick was saying, also Department of Public Works and Infrastructure 8 days ago, through a government gazette, published this National Infrastructure Plan 2050, or NIP 2050. And Patrick already mentioned the 273 projects, and there they talk about the infrastructure finance gap. You can get that, that government gazette, and look at that document. It's quite interesting. But there, the infrastructure finance gap, and I didn't put the numbers in here because it's all trillions, and we all know how behind infrastructure development is in South Africa. So I don't know how did they calculate, or etc., all those trillions of that infrastructure finance gap. But the big claim there is that a third of that gap will be filled through PPPs, and that's where that 273 projects come from. So that is the good news for us for the foreseeable future, at least hopefully up till 2050. But if it gets implemented, etc., we all know, we all got a light question around that. But if only a portion of that should come to the market, it would be brilliant news for us. So the big, if you talk about people that's not in the know of PPPs and people that's in the know, that talk about the complexity and the barrier to entry PPPs. And this regulation 16 is quite onerous, and the processes around that. But and in this NIP 2050, it's also in there about the regulations are currently being revised to simplify the approval process, to standardize models and speed up the processes. And the last bullet there, also National Treasury is revising the frameworks for on-budget and PPP procurement to facilitate and increase flows of PPPs. So I think from a political point of view, especially with the change in government 2 or 3 years ago, there's a lot more positive outlook onto PPPs than was previously. So what I'm actually need to talk to is the contracts. Yeah, you've probably, a lot of you have seen the standard structure of a PPP arrangement. I'll just quickly go through that from the top, where you've got the client or the government department or the institution, where it's often referred to, that needs some infrastructure that needs to be financed, built, operated, and maintained, and then transfer at the end. A private party or a special purpose vehicle will be formed by a consortium or a grouping. Normally construction partners, operations subcontractors, that's where we as the facility management partners come in, and then equity partners. So the contractual arrangements that I'm talking about is first that PPP agreement and the schedules. that's between the government and the private party. Then to fund this structure, obviously the traditional or the simplistic method is through debt and equity. And there's different ratios of debt to equity, maybe 70-30 or 80-20 or 90-10 if you're lucky. So that debt will be provided by one of the commercial lenders. And then there's the loan agreements coming from the debt. And then the equity, by your equity, the shareholders, there's the shareholders agreement between those shareholders and everything that gets regulated around the management, etc., of the private party, of that special purpose vehicle. A discussion point for PPPs is always the barrier of entry. For instance, a typical PPP project, the accommodation project, might be R1 billion or 1.5 or 2 billion rand. So if you look at, let's say, R1 billion, debt might be 80%. So you need 800 million borrowed from commercial lenders. And then the equity, the shareholders need to put in the remaining 20%, which is 200 million. So for equity partners, you need people with quite a bit of stake and the capacity to raise equity of 200 million. So that's where people say, but they can't enter the PPP market, but that's a discussion on another point. And then at the bottom left, you've got the design and construct subcontractor with the D&C subcontract. The guy that's going to design, build the building basically as a turnkey contract at a fixed price. And then the operations subcontractor, and I think this is where probably everybody that's attending this today is or predominantly in that field, the facility management service provider, because the PPPs are over a longer term to basically to service the debt, very much like your house. The term might be 20 years to repay your bond. The loan agreements is for 20 years, and therefore for us as an FM operator, it's quite beneficial to have then a service contract for 20 years or 25 years or whatever the period might be, or 15 years. A very important agreement is the interface agreement between the operations subcontractor and the design subcontractor. Just to keep that in mind, I'll just quickly discuss each of these agreements very shortly. First of all is the PPP agreement and the schedules. So that's the one at the top there. When I was involved for the first time in a PPP, it was an accommodation PPP, and back in 2003, 2002, I think it was, I was asked to attend and represent the operations subcontractor as a new guy in FM. And all the parties that you basically see here were represented at that negotiation meeting, each with their legal team. Oh, yes. I want to say loyal team, not loyalty, the legal team, they're not loyal. And so each, and on the PPP agreement, before we got to the schedules, just the definitions of the PPP agreement took 2 days to get through those negotiations of the definition. And I thought, good golly, what is all this about? That you take 2 days just to negotiate the definitions. We closed the deal a few years later after negotiation. So it does take a lot of time, a lot of effort, a lot of cost to actually get, and therefore that revision of the regulations to hopefully bring it forward. As I said, the PPP agreement typically has got like 25 schedules. It can be less or more. Some of the main schedules that I've just highlighted here, the payment mechanism, including the penalty mechanism that flows down to the operations subcontract. Then you've got insurance, location principles, how location should be done. And then the handover, where Patrick talked about some of the concessions are coming to an end, that final maintenance survey where the building needs to be in the same state as it was when it was new. So everything around that. Then the loan agreements from the lenders, you remember the guys on the right, the main agreements there is the common terms agreement, subordination agreement, shareholder session and pledge agreements. There's also around about 10, I just looked at a few projects that I was involved with and just came up with that number, just the average. So it's a tremendous amount of legal documentation. Just by this first two, it's already like 2 or 3 boxes full, just if you should print it out. The shareholders agreement from the equity suppliers, and then we get to the D&C subcontract and schedules. Now, the main principle in PPPs, and I'm just going to go back to the previous slide, is this private party in the middle. And there was one lawyer, a very good lawyer that most people in the PPP environment talks about and has worked with. And she always said, remember, the private party is a man of straw. All its responsibilities and obligations gets passed down to its 2 subcontracts, basically. So every aspects that's in the PPP agreement coming from the client body are basically a pass-through, and it's a back-to-back agreement. So whatever they've got, it either needs to be absorbed by the D&C subcontract or the operations subcontract, because the private party will always say they don't have money. There's nothing that they can't really solve this the problem. It needs to be solved by one of the 2 subcontracts. So the principle of the 2 subcontracts is a back-to-back agreement of the PPP agreement that sits at the top. So the D&C, or design and construct, they got different names, the construction subcontractor, or sometimes EPC subcontractor, although I believe they're not a pure EPC guys in South Africa. They must design the building, and here the design is also a little bit problematic from time to time, as the consultants, the professional team, the architects and all the engineers actually work for the main contractor. But be it may, so the main contractor is responsible for the designs, providing the space, the building, the furniture and everything, the fully fitted out building that goes with that, for a fixed quality, price, and for a specific period. And
I'm not going to cut you short, about another minute and a half or so. Thanks very much. Sorry.
Okay, then on the operations contract, again, similar to the PPP agreement. And here we've got, in addition, the service level agreements. And FM environment, we all know about service level agreements. It includes the performance specs, the measurement and reporting. The important one here is the interface agreement between the operations subcontractor and the D&C guys, where our role throughout the design and construction is very much regulated. We need to sign off that project and then deal with how defects are dealt with is also in the interface agreement, because the construction guys don't want to be on the cards for 25 years for defects. So at some stage, the FM guys need to take it over. So just to add on, this is my last slide, to add on to Patrick, we basically provide hard, soft, and business support services. And where we play is in office accommodation, healthcare, and student accommodation, although not typically a pure PPP with that SHIP projects within DBSA. Student accommodation is also up there. And the main risks, and I think Cliff will touch on this, for the FM guys, we need to price a fixed price for the whole concession period, even upfront before you reach with the construction period. So if a PPP is 25 years, you need to add 2 or 3 years construction. So the price that you put today on the table is fixed for the next 28 years, and you can't adjust that price. You need to take in that risk. You only get inflation adjusted. So that's the big issue. And then we need to deal with asset deterioration and the replacement. We normally budget in a maintenance reserve account or a life cycle budget, and then also to deal with the defects coming from the construction guys. So that's very short and sweet, a little bit on the contractual arrangements. Thank you, Johan.
Thank you very much indeed. Thanks for that presentation. I'm sorry I'm having to raise the timing bell and with you guys, but really appreciate, wish you had more time to carry on. I know there are going to be questions. You've very well covered the aspects in terms of the construction matters, touching on regulatory framework, complexity and the barriers to entry. And I'm sure that's going to give food for thought for questions later on. So Bo, thank you for covering contractual matters. Moving on to Cliff Hocking now. He's going to be presenting on operational issues. I think we're building up slowly, and now we're touching on the operational issues, a 20-25 year period. Cliff, over to you. Thank you very much.
Half a second.
Thank you. Just need
got to find my way around this thing here quickly.
Got about 2 seconds. There we go. Almost.
Well, we should be there.
Not as yet. It's not coming up.
We're not there yet. Oh dear.
No.
Okay.
No.
Yeah.
I
This is-
don't know. Can't see where your PowerPoint.
This is like a good demonstration.
No,
Nice.
that is fine. That is fine.
If they're going to go wrong, they're going to go wrong, boy.
No.
Let's get back to square one. Still no screen to be seen.
We can
Not
see
as
your,
yet, Cliff. Yeah, we
We
can see
can-
your screen, but can't see your presentation.
Okay. Get out of this one and then we can maybe find it somewhere.
Try that. There we go. There we go.
Okay.
You're back. That's looking promising.
There we go.
Thank you. Wonderful, Cliff. Over to you. Thank you very much.
We've
That's
got to get into,
hopefully 10, 12 minutes. Cliff, over to you. Thank you very much.
all right, we just got to try and get into
Presentation.
slideshow,
mode. Yeah.
Yeah. Do that.
Bottom on your toolbar.
Now I've got it. There we go.
Okay. Lovely. Thank you.
At last.
Good.
Apologies
All right.
for
Over
that.
to you. Not at all, Cliff.
Not too many. When you've got too many buttons on the screen. And thank you, Johan. Thank you, SAFMA, and thank you for that introduction up front. It's indeed my pleasure to be here this afternoon. In fact, at my age, it's my pleasure to be anywhere at this time of any afternoon. So let's hope we can share some ideas and some experiences. The issue around the contracting has been covered. The issue around the stages within the PPP process have been covered adequately by Patrick and by Boa. But where does facilities management or FM start in this whole PPP process? And the obvious answer to that is right there during the procurement stage, during the bid process, that all of us have had a lot of experience at, all of us that have been involved in PPPs have had a lot of experience at. And that's where one has the opportunity to get it right first time and to make sure that should you be successful, and with the costs involved in bidding, one doesn't really take part in these things to come second, that the project is actually going to work to the benefit of all parties. And it's during this procurement stage, during this bidding stage, that FM has a vital role to play in terms of design reviews, in terms of interaction with the professional teams, in terms of looking at the practicality of the bits and pieces that are being proposed or being suggested for whatever infrastructure is being developed. I go to great lengths to explain to facilities management individuals on these teams that we are not design engineers, and we should not pretend to be design engineers, and we should not pretend to be architects. Although personally, I must confess to having numerous interesting debates and sometimes interesting arguments with architects at this stage. It is also during the procurement phase that we have the opportunity to review the output specifications. And as we know, these output specifications become the service level agreements. And as Boa explained, the whole issue around the contractual side of a PPP are very intense. So we need to ensure that the output specifications can be met, that the service level agreements that will come from those output specifications can be met with confidence, and that service delivery will, in fact, be what is required in terms of the contract. It is also during this procurement phase that one has one stab and one stab only at getting the costing right. As has been emphasized previously, if we get it wrong here, we're sitting with that wrong calculation, that wrong number for 25 plus years. So the issue around involvement, diligence, and actually knowing what we're doing is of vital importance when that procurement is taking place. Of course, during the design and construct phase, there is ongoing involvement of the facilities management team, of the operations team, leading up to the financial close and to mobilization of the operations contract. I explained this in great detail as to what an operations subcontract is all about and what the operations subcontractor is all about. And we need to emphasize that service delivery within the PPP environment is far more contractually driven and far more contractually managed than in any other facilities management environment. And I can agree with Bowen extensively that the contractual negotiations and the discussions that go about finalizing these contracts are fairly awesome, to say the least. Mm-hmm. We then move into the risk elements, and if we look at the makeup of a triple P, your design and construct costs, and Rachel's going to go into financial aspects in a lot of detail, but your design and construct costs could run at between 40 to 50% of the whole life cycle costing, or the whole cost of project. And that is for guys that are going to be involved for 2 to 3 years. The operations and maintenance, or FM side, can make up 50 to 60% of the total cost of project. And we as facilities managers sit with that for 25 years. So just a re-emphasis of the need for a mentality to be around the contract management and the management of the contractual side of the PPP in terms of operations. We are heavily bound by things that are covered in initial proposals to the client, because that develops into a baseline, that develops into a contract, and the marketing propaganda that a lot of people rely on in bids and in proposals actually becomes a case of, well, you promised that, and that's what you're going to deliver against, because that's where your where your service is going to be measured. So I think it's imperative that we have that mindset from day one, that contract management is the key factor. We need to state that it's not only on the service providers side that contract management is key. It is also on the client side that contract management is key. And we've all seen examples where PPPs have been alleged to have not gone according to expectations. And on analysis, we found that that contract management has not been up to scratch on both sides. So to emphasize, it's all about contract, and knowing what you've promised and what you've raised in the mind of the client.
So I'm going to cut you short another minute, please. Thank you.
Good enough. Thank you. As with any FM contract, but a little bit more so here, we need to focus on things like quality of service, which is a given. We need to focus around the innovation that is required from facilities management. We need to focus on the flexibility that is required from facilities management. And we need to be fully aware that during the operational phase of a PPP, penalties play a fairly big role. And of course, no FM service provider, no operations service provider actually wants to be hit by penalties, because those things hurt. We're going to come to questions and so on later. So thank you very much for the opportunity.
Cliff, thank you very much indeed. Really appreciate that. You've covered very well the operation issues, the stressed contract. For those that can stay on, I mentioned we're going to run through, and we are running a little bit late, but we are going to now ask Rachel to talk to us and present on the structures and finance. There are some Q&A questions which are being answered as we go along. Please post them. We will get them later in the chats as well. So Rachel, over to you. We're looking forward to the money side of issues, the structures and financing. Thank you very much indeed.
Good afternoon to you all, and thank you very much for the opportunity. I hope you can all see my screen.
Yes, we can.
Okay, excellent. So a very big thank you to my colleagues that have presented on the different aspects of the structure of the contracts and details of those contracts themselves, as well as the facilities management aspects in terms of the operations for the remainder of the period. And, just for process purposes, we do have a disclaimer that the views that are expressed are my own views and not that of SAFMA.
Thank you.
Okay, so we're going to run very quickly through, I think my colleagues have covered all of the main aspects around the triple P model. And I'm just going to touch very briefly on recent trends, what the fiscal focus is, the debt and equity requirements for investors, as well as facilities management in terms of the project. We look at it and what is the financing factor and fantasy around these projects, and what the issues and opportunities are actually for us. I'm not going to dwell too much on this slide. We have seen that in the previous presentations. So I will dwell quite for some time on the loan agreements and the senior debt, as well as the equity funding, and what does that mean for the operations subcontractor and the FM industry going forward. So basically what we've seen in the recent trends around the triple Ps, we are sitting in a difficult economic climate, and this has an impact on the funding markets that we're looking at. There is an increase in more innovative financing structures that we need to be looking at as an industry, just to actually make these projects or transactions work for the 25 or the 10 to 25 years plus. And the reason for that is not everyone has got a crystal ball as to what's going to happen in the next 5 years. And that has become a little bit more real for us since the COVID crisis. And before the COVID crisis, our own economy locally here in South Africa, we were sitting in a situation where, you know, our funding partners are looking at the economy and the slug in the economy, and where and how are we going to find money to finance these infrastructure projects. So you've had a lot of talk now in the industry around the blended financing opportunities. We've had a lot of increase in terms of economic inclusion. And all of those discussions come through from what our micro and macro economic objectives are and what is actually what we're currently experiencing on the ground and realistically. So we have infrastructure programs from the Sustainable Infrastructure Development Program to the programs that the presidency has actually put forward to say, how do we actually revive this economy? How do we get investors back into the country and interested in projects such as triple Ps? So as we look at all of those aspects, we also have a situation where we have the people who put in the most amount of money being our lenders and the finance institutions saying, well, the risks for us have increased over a certain period of time. And this is actually cyclical, it's globally driven, it's market driven, and one needs to look at it, or one needs to look at the investment approaches into triple Ps from that aspect, because the market will fluctuate. So also part of the recent trends and what has been touched on by my colleagues previously or earlier on in the discussion is just the recent discussions or the recent developments at GTAC through National Treasury, etc., in terms of bringing triple P projects to market much sooner. I think historically, we have seen that triple Ps do come to market after 5-10 years, depending on the sector of the project, depending on the appetite for the project for it from a lending market. So that does pose a challenge, that does pose a challenge for potential investors such as your FM services providers who are part of this triple P project, you know, for the long haul. And like my colleague actually mentioned earlier, it is around having that initial buy-in at the initial proposal stage. When you go through the whole Treasury approval process, do you have your market and community buy-in? And all of that actually influences the lending decision. So in terms of fiscal focus and where the money is and where and how we need to follow the money, and I believe Patrick actually did touch on this earlier, these are the sectors: energy and water, transport and logistics, healthcare, housing and student accommodation, that are receiving the most attention from the fiscus at this stage. And why it's important to actually understand as a potential investor where the fiscal focus is because that's where the money is going to be. And that is where the lenders are going to look. And that is where your potential equity investors are also going to look, because there's a risk discussion that needs to come into all of this, or there's a risk discussion that is actually embedded in quite a lot of these investments. So in terms of your debt and equity structures, what I'd like to mention is that for each triple P or each infrastructure investment, there is not a one-size-fits-all sort of investment structure. I can't say it's 10% and 90% debt equity structure. Everything depends on the quality of the cash flows. It depends on the quality of the consortium that you put together. It depends on the quality and track record of the balance sheet that all of those parties actually bring to the table. And then there's the understanding, and I think that's quite a critical point, that potential investors, as we look at all of these infrastructure projects, what is your specific individual investment approach? And what is your very specific debt and equity structure? Because then that changes the game quite a lot in terms of the modeling as to how viable a project is going to be individually for a consortium. So in the current markets that we're looking at or we're facing right now, we do have a situation where you see there's been a shortening of the debt tenures. Why? Because the market and economic risk has increased. So that places quite a heavy reliance on equity participation. And when we look at equity participation as a country in general, then it is a case of how much access to capital all of the participants that can or would be interested in infrastructure projects be able to bring to the table. And what does that look like for a very specific cash flow structure and a very specific cash flow profile? Because that's what your lenders are going to be looking at. And you'll see further along in the presentation, lenders are risk averse. So quality of cash flows, quality of your contracting partners, quality of the department that's actually, or the end user department that's bringing a project there. You know, at the beginning of this session, it was mentioned that, you know, the NMP has got 173 projects in the pipeline. And the reality of that is, if you look at what has happened in the last few recent years, a lot of projects have not come to the market or have not been put forward for implementation because of feasibility studies and because of issues around whether or not the specific end user department can actually afford the project. So the 3 points that were raised also by, I think it was Boa, your affordability, the value for money on the specific project, and as well as the risk transfer and how well you've transferred that risk. And very specifically for the FM industry, that transfer of risk is quite critical because, you know, for the first 2.5 years after construction is done, it might be a lot easier to raise debt for the construction, but to ensure that you've got working capital and operational capital for the remainder of your 25 to 30 years, depending on how long a concession is it can be quite challenging. So it really does rely on the quality of the underlying asset and the quality of the cash flows, and also the quality of the stakeholders that are invested in this project. Stakeholder management plays a very key role in ensuring the success of triple Ps. And that is something that I think needs to be very well understood. We do
Rachel,
not have
another 5 minutes. Sorry to interrupt. Are you fine with
No
that?
problem.
Thank you very much.
am-
I'm going to slightly overrun our question answer session. Sorry to the delegates participating. We have got questions posted that we'll try and answer, but I think we'd love to give Rachel opportunity to present. Please go ahead,
Okay.
Rachel. Thank
No,
you.
Thank you very much, Johan. So there's a lot of cost elements that are involved in actually at the SPV level that also then flow down to your FM level. And as Cliff mentioned just earlier on, in terms, if you do not get that number right at inception, then from an investor perspective at an FM level, the risks then are very, very high. And it's all in correlation with what is the long-term view of your lending partners, what are the obligations that you've committed in terms of penalties, etc., that are going to flow through from the private party or from the user department through the private party and down to the FM management company. And one of, we spoke about what are the financing fancies around triple P projects. First of all, I think it's very important for the investors to actually understand that it's not quick and immediate cash returns for equity investors. It is a play for long-term capital and long-term investment. So the returns are not immediate. The first bite at the cherry does go through to the lenders. And then the service delivery portion, the operations phase of the project, is where it becomes very real for FM, and those numbers need to be right. So, just taking into account, and also what I think the FM entities need to be very, very aware of is that the contracts are not set in stone. I do believe that, in some instances, you do have investors that believe that contract is set in stone. Therefore, if I've signed the contract for 25 years, then I'm going to be in this business or on this concession for the next 25 years. The markets change, contracts evolve, economic and operational trends change, and the FM industry really needs to be very much on board and very much on hand with their supply chain downstream to manage those changes. And I think I'll stop at that point, and we can go into the Q&A, and I'm happy to share the detail of these slides with yourselves. Thank you.
Rachel, thank you very much, Need, for that presentation. So we had a very good summation there of the previous presentations as well, and touching on the finance side of it. You alluded to the earlier points that Bo also brought out about affordability, value for money, and risk transfer, and senior debt and equity debt as well. So really do appreciate that. Thank you to all the panelists. There have been questions posted. There are 10 questions. We're just on to 13:11. We were going to go through till 13:30. So can I ask the panelists, please, just to have a look at the questions that have been posted, and you can try and answer them there. If you wouldn't mind, please. I'm not going to nominate anybody, but we can just run through and confirm. There's a question from Vaynant. I think that was answered. So thank you, Patrick. Rochelle, I agree. Notumbafuti, yes, we can. Rachel, Michael Rivoli. There's a question from Michael. Your CapEx seems very high. If you remove finance, you're looking at 40% of CapEx and 60% for OpEx, maybe in a PPP, but not in conventional construction projects. Rachel, that could be a financial question, or maybe Patrick wants to come in there, or either Bo or Cliff as well. Please, over to you to perhaps answer that one, if you can see it on your screen.
Thanks, Johan. Yeah, I was quoting that roughly CapEx is a third, FM's a third, and finance costs are a third, and that relates specifically to a PPP contract. Thank you.
Thanks very much. Thank you for that, Patrick. Good. Moving along. Let's go down this list. Okay. Another question from Michael. Note that all infrastructure projects, be they funded by government or PPP, should be regulated by the FIDPM, and therefore much of the work which takes a long time to complete should have already been completed and approved by the relevant Treasury ditto for entities regulated by the MFA, Municipal Finance Management Act, as of July 2021. Any comments from any of the panelists on that comment from Michael, or anything, green or disagreeing, or? Okay. Anybody to comment on that? Should I nominate somebody?
Okay.
Should I? Rachel, would you like to, please?
I will try that one. And
Please.
basically, I like to say that, infrastructure projects are going to be regulated by the relevant regulatory environment or legislation, particularly attached to that sector. So as much as it may take a long time, I think the regulation itself is not the issue. It is the project preparation and how quickly whatever regulatory body or is bringing that project out to market, how their processes and what their governance structures are around ensuring that, by the time it's published, it's actually ready to complete and deliver.
Thank you very much for that, Rachel. Just before I forget, there's a poll, please, that we're asking participants to complete. I notice some participants are dropping off, but before you run away, please, is there an appetite for another webinar to discuss public-private partnerships? You got a yes or no, and should we invite panelists from National Treasury to cast more light on the actual status, plans, and future of public-private partnerships, seeing the tenders for PPPs and the management of is still done by National Treasury. So please fill in that poll. Appreciate that. Going back to the Q&A questions that have been asked. I see we got some more. Vainant Dreya. At DERCO, we put FM at the center of concessions. Did it work for FM? Who would like to answer that? Is that a operational issue? Cliff, maybe you'd like to come in there?
Yeah, I'd be loath to try and speak about any project specifically, having not been involved in the operations of DERCO, but having been involved in other aspects of DERCO.
Right.
This whole issue around viability and risk transfer and so forth is a very, very touchy issue. From my knowledge, and I think my knowledge goes as far as what is in the public domain, is that that DERCO is a successful PPP, and that DERCO is being managed well, and that the client organization is satisfied with what's going down there. And I repeat, it's not necessarily a view that I've scientifically drawn. It's a view that I've drawn from information that's available in the public domain.
Thank you very much. Boa, do you want to come in there, please?
Thank you. Thank you for that question, Vainant. Good to hear from you again. I saw a very similar question from Andrew Mason under the answers section, under the Q&A around facilities management involvement. When Vainant was still involved at DERCO, all the major construction companies had concession units or specific teams of people that just specialized on concessions, a lot of them coming from the toll roads, which was sort of the first few projects. And we as the FM operators came almost as Johnny come lately to the process. And we didn't have that knowledge that the concession units of the major construction companies had, and they traditionally took the lead in the private party, and specifically Vainant as well led the DERCO process in the beginning. But of late, and unfortunately, a lot of the big construction companies, their concession units dissolved, and with the difficulties in the construction industry. And it took some time, and I think only of late is FM really stepping up to the plate. And some of the concessions and the bids that's actually being led by facilities management, which was the intention right from the beginning, and on Vainant's and Andrew's question as well, that FM should really take the lead. We there for 20, 25 years. We actually the face of the client for that period. And right from the beginning, we should actually be the lead negotiator with the client. So that's why I think that the FM companies are slowly stepping up and taking the lead within that concessions environment, where traditionally it was done by the construction industry.
Thanks very much for that, Bo. Thanks for picking up that. Yeah, just looking at some of those. Sorry, Patrick, do you want further comment or add to that?
I'll just hand over to Rachel, because I'm sure she can speak more on DERCO than I can.
Rachel?
Thank you, Patrick. Johan, I just wanted to support Boa's comments in terms of FM needing to take a very leading role from inception. And as he's rightfully said, FM is on the project for the majority of the remaining period of the project. So it is imperative that the FM industry from inception is definitely involved as a project partner to ensure that you do have the correct project delivery throughout the life. It is it's quite critical.
Thank you. I think under the question answers, could be answered. Just want to see if it has been covered. Surely the frequently changing political structures in municipalities impact the PPP cycle from pipeline dreams to fruition. How is this addressed? How is that addressed in agreements? Would somebody like to venture and answer that? One of the panelists, please.
I will take a stab at that.
Please, Rachel, thank you.
Basically, how that is addressed in the agreements is in terms of the flexibility of the clauses that are actually applied therein. So you'll see that the financing structures, because basically it is a financing question that has been raised, that those structures, depending on the way that the project has been structured, are sensitive to the changes in the macroeconomic environment. But one of the aspects that I think needs to be highlighted a little bit more for FM is in terms of the alternative best use specific assets, especially if it's a very specialized assets. You need to look at, we don't all have a very confirmed view of what's going to happen in the next 5 years, 10 years, just as COVID has taught us. Sure. However, it's quite important, I think, at its inception phase to understand your cyclical nature of the economy and macroeconomic environment, as well, and plan ahead from a maintenance perspective as to what else it is that you can do for that asset in the periods where the cycle changes.
Thank you very much. Thanks for that, Rachel. A question from Andrew Mason, if I could, please. Hope there's anonymous. How do smaller entities engage in this space, like what Patrick alluded to, in partnering with other bigger players? Would somebody, Patrick, you want to respond to that, or one of the panelists, please?
Yeah, I think it's a role that SAFMA can actually assist with, and it's through education. It's through having parties submitting their credentials and their interests, and actually trying to match up skill sets to respond to projects. And as we get more projects coming through the pipeline, those opportunities are we're going to need more and more capacity, and a function that is undertaken by SAFMA, I think, could definitely assist.
Thanks very much for that. Thank you. SAFMA's been doing some good things in the educational space, the NQF Level 6 Diploma and Facilities Management. Hopefully, anybody needs information that they're welcome to contact Marianne at SAFMA offices, head office in Tabili, and that's Marianne's team. Andrew Mason. Andrew, good to have you on board today. How do FM operators take a greater role in the PPP process, which was the original intention? Who of the four panelists would like to answer that and still have a beer with Andrew after they've answered that?
I tried to answer that, but maybe.
Did you?
Yeah.
Sorry, Patrick, did you? Sorry, okay.
Yeah, I think Bo has already touched on it.
Has he answered that? Sorry, I'm not picking up that. Okay, let's move on. Thanks, Bo. Appreciate that. All right, let me go to the open questions then. Let's go. Michael, thanks very much. Love you have you on board as well. You are posing some very good questions here. Let's go down to Quiet M. The issue of FM being systematically excluded from development seems to be prevalent in the private sector as well. History is replete with development handing over buildings to FMs with rather impractical, inefficient, and unserviceable services, elements, and equipment. That sounds like something on the Cliff that you'd maybe like to venture and answer on.
No, I don't think it's applicable at all to the PPP environment, because FM is involved from day one, and FM has to sign off on design issues. FM has to agree to a whole lot of bits and pieces. So there's in the early days of PPP, and particularly the first one, and I think Bo alluded to that without mentioning a name. There was no FM involvement up front, but that has certainly changed over the years, and I see it changing even more, and particularly in the light of the need, and it's a huge need for FM to start driving these issues.
Thank you.
That will disappear more and more.
Cliff, thank you. Patrick, do you want to add to that at all, please?
Yeah, I agree with Cliff that FM has taken a much bigger role in recent times. And now that we're getting to these other types of projects where there's a very small build element and you're taking over a 20-year-old Toyota Corolla and you're having to take it forward into the next period of time, FM is going to have to develop that capacity internally to be more focused on leading these bids.
Wonderful. Thank you very much indeed.
And then also
sorry.
driving that to
Yes.
Toyota Corolla while you're trying to repair it is also the issue.
Thank you. Thanks for that, Cliff. Right. If you do some research on the success of the public-private partnerships for the panelists that are there, River Sands, a successful public-private partnership. The first one was at De Hoop, and then that concession that was there. There's several others, the Century Property Developments and Treasury in Centurion, the taxi rank there. There's several others which have really been very successful. And then SA Brews got in with a whole lot of water projects as well in Tshwane and City of Cape Town. They also serviced accommodation, healthcare, tourism, transport, correctional services, PPPs, which have been very successfully completed. And having spent quite a bit of time at the DTI offices in Tshwane, that was very interesting for me, and seen quite a few others. Anything more from the panelists? I don't know if we got any more questions. We should be wrapping up now. I don't see any more. I don't see any more questions. Should we do a wrap up at all, going around the clock, if we could, please? And again, thank you very much for our participants. Thank you very much to our panelists for giving up their time. Really do appreciate it. Thanks for the questions that are posed. I hope we've answered that. Bo, are you on? Is there anything you'd like to comment on? Sorry.
Yeah, just on that previous one, FM involvement, we did a comparison as for normal developments as well around the processes in a normal construction where the construction guys have, I think it's 9 stages of that development, and we mapped the PPP process next to that. And that's the PPP processes are actually a very good example of how FM should be involved throughout the design and construction phases of any project, which was quite interesting.
Sure. Thanks very much. Referring to the POXA one, I think there's 6 stages, and thanks very much. Yes, that's the one. Thank you very much. Thank you. Right, we are slowly moving towards the end of the webinar, and again, please participate in that poll that has been posted out by Marianne. So, to the 4 panelists, Patrick, thank you very much for talking to us on sector participation. I think you laid the groundwork for the whole session going forward. Boa, thank you very much for talking to us on contractual matters and presenting as well. I think you alluded to a lot of excellent points there. Cliff, thank you very much for talking on operational issues as well. Really appreciate that. And Rachel, thank you very much for talking on structure and financing. I think those 4 themes that we spoke about really were all well interlinked and well presented by the panelists. On our theme again, it was public-private partnership, fact or fantasy, and Patrick's words, I think fact or fiction. Lovely to know that there's the NIP 2050s there, the 273. If I got the number right, Patrick, please to be looked at. I think it's page 10 of the document starts mentioning the PPPs in the first pages of that NRP 2050. And we look forward to exciting pipeline of projects that are there. And yes, Patrick, agree with you. Nobody can predict that pipeline, predict it. But I think by all accounts, based on the past records of the PPPs complete in the country to date, and I don't have a number on me. I know it's well over 100. Perhaps somebody can help me with that. I saw a number of 122 somewhere. I think we're in for exciting times. So please participate in that poll. If we'd like to have another webinar, bring your National Treasury on board, we can certainly do that. So from my side as chairman again, thank you very much to the panelists. I'm sorry I had to gong you out. for your time. You presented extremely well. And Patrick, thank you very much. Boa, Cliff, and Rachel, appreciate that. And to the rest of the panelists, enjoy your rest of your day. Thanks very much indeed.
Thanks, Johan.
Thank you very much.
Patrick. Thank you, Boa. Thanks, Rachel.
Thanks, everyone. Bye.
Thank you.
Thanks,
Thanks,
Jan.
Cliff.
Thanks, Patrick, Boa, Rachel. Nice being in touch. Cheers.